Thinking of entering the personal hygiene FMCG market? Brace yourself. The industry is fast-paced, highly competitive, and full of innovative diapers. I mean, disruptors. Here's the external analysis you need to navigate the world dominated by giants like Kimberly-Clark and stay ahead in the game. Alright, hygiene hustlers, so you want to break into FMCG personal care game? Before you go full throttle selling wipes and diapers, let's talk about the forces that could either launch you or wipe you out. Yep, it's Porter's 5 forces, but make it spicy. First up, competitive rivalry? Oh, it's high. We're talking big dogs like P&G, Unilever, and Kimberly-Clark owning 58% of the market. You think you're the next Charmin? Think again. These brands are battling out with eco launches, flashy R&Ds, and price cuts sharper than your auntie's scissors. Value, sustainability, promotions, it's a brawl in the hygiene aisle. Threat of new entrants? Low. Unless you've got $50 million lying around. Regulations take 2 years, shelf space is locked down, and these brands, they've got loyalty points, bulk deals, and factories that eat your startup budget for breakfast. Unless you're carving out a niche eco-friendly corner on TikTok, better stay out of soap war. Supplier power? Moderately sweaty. Only 5 pulp kings control 82% of the game. You want to switch? That's $3.2 million per production line, honey. And don't even mention global supply drama. One flood in Asia and suddenly everyone's out of diapers. Buyer power? Through the roof. Consumers scroll, compare, and switch brands faster than you can say unscented. A 1% price increase in diapers equals a 1.4 sales drop. Plus, giant retailers like Walmart now sell their own products. So yeah, your buyer might also be your rival. Fun, right? And the threat of substitutes, let's call it moderate, but creeping up. You've got menstrual cups, clothes diapers, bidets, biodegradable wipes. They're not mainstream yet, but with a 14.5% growth rate, they're coming for that throne. FMCG may be essential, but that doesn't mean it's irreplaceable. Bottom line, the personal care market looks cute on paper, but behind those shelves lies a battlefield of innovation, loyalty, and pulp politics. So if you're planning to enter, better come prepared and maybe pack some tissues. Now let's go to PESTLE analysis. Politically, it's a tricky game. Trade tensions like the US versus China showdown can mess with supply chains and spike tariffs. But on the bright side, global hygiene campaigns are giving the industry a boost. Still, things like political unrest and shifting tax laws, hello OECD global minimum tax, can make staying profitable a tightrope walk. Economically, it's a pressure from all sides. Inflation's up, raw materials are expensive, and labor costs are rising. Plus, the threat of recession and shaky currency make it harder to plan. But look, East and South, countries like India and Nigeria are booming with growing middle classes and fresh market potential. Socially, people's habits and values are shifting. An aging population means more demand for adult care products. Urban lifestyles want quick, clean, and eco-friendly options. And in more conservative cultures, brands need to be sensitive, often turning to online platforms to market products discreetly, especially in feminine care. Technologically, it's adapt or it'll get left behind. Automation and smart manufacturing are making factories faster and smarter. Meanwhile, digital retail and marketing are non-negotiables in today's e-commerce driven world. Oh, and don't forget innovation in biodegradable materials. It's what the eco-conscious crowd demands. Legally, the rules are tightening. From product safety and labor laws to intellectual property protection, FMCG players need to play by the book, especially in regions where enforcement is still catching up. Environmentally, it's go green or go home. Climate change, plastic bans, and stricter carbon rules are pushing companies to invest in things like renewable energy and sustainable packaging. The pressure is on, but so is the opportunity. Bottom line, the FMCG hygiene industry does not just survive in a complex world. It innovates, adapts, and hopefully stays one step ahead. Ever wondered how hygiene giants stack up in the wild world of FMCG? Let's break it down with a strategic group map. On one axis, we have product variety, how many categories a company plays in. On the other hand, market share, how much of the market they actually own. Procter Gamble, they're the Goliath. Huge variety, massive share. Unilever, right beside them. Think Dove, deodorants, and even tea. Kimberly-Clark, more focus. They dominate diapers, tissues, and feminine care. Essity, similar focus, but stronger in medical and European markets. So what does this map tell us? It reveals how many companies choose to compete. Some go wide, others go deep. Big doesn't mean always better. Sometimes being focused is the smartest move. Moving forward to value chain analysis. In terms of primary activities, inbound logistics, P&G has a global supply network and long-standing relationships with raw material suppliers. Their just-in-time inventory systems and advanced forecasting help reduce costs and improve responsiveness. Operations: P&G operates in more than 70 countries, maintaining highly automated and efficient manufacturing plants. Their use of smart manufacturing and sustainability practices contributes to both efficiency and brand value. Outbound logistics: they have a robust global distribution system, including partnerships with major retailers and distributors. Their use of technology and data analytics ensures product availability and customer satisfaction. Marketing and sales: this is one of P&G's strongest areas. Their brand portfolio, including Tide, Pampers, and Gillette, benefits from heavy investment in advertising, digital campaigns, and customer analytics, keeping them at the forefront of consumer preference. Service: P&G supports its products through warranties, customer support, and feedback channels that inform innovation. This closes the loop and contributes to customer retention. Support activities also play a key role, starting with firm infrastructure. Strong governance, financial management, and a decentralized organizational structure allow quick response to market changes and regional needs. Following this is human resource management. They are known for leadership development with a strong internal promotion culture. This has helped create a knowledgeable and motivated workforce. For technology development, P&G invests significantly in R&D. Their innovation centers drive product development in areas like health, sustainability, and convenience. Lastly, procurement. P&G's procurement strategy is centralized and strategic. The company uses its scale to secure favorable pricing while building collaborative relationships with suppliers. Procurement is digitally integrated, allowing P&G to track sustainability, compliance, quality in real time, making it both cost-effective and responsible. Together, these activities reinforce P&G's operational excellence and responsiveness to global demand. We move forward to the current strategies employed by the rival companies. Starting with P&G, Procter & Gamble's current strategy centers around 5 core pillars. First, they maintain a focused portfolio, concentrating on 10 everyday product categories where performance strongly influences brand choice. Second is productivity. P&G constantly drives cost efficiency and cash flow to reinvest in innovation and growth. Third, they're committed to extending their margin of competitive superiority by delivering excellence in product, packaging, brand communication, retail execution, and consumer value. Next is constructive disruption. The company proactively embraces innovation and change to stay ahead in an evolving marketplace. And finally, P&G builds an empowered organization, fostering an agile and accountable culture that can quickly adapt to shifting market dynamics. Together, these strategic pillars support P&G's continued leadership and long-term growth in the global consumer goods industry. P&G's strong global brand portfolio, featuring Tide, Pampers, and Downy, is valuable and rare, though not inimitable, because P&G is organized to capture value. This gives them a temporary competitive advantage. Their global manufacturing and distribution network, while valuable, isn't rare or inimitable. It helps the company stay efficient but results in just competitive parity. One of their most powerful resources is their innovation and R&D capabilities. These are valuable, rare, and difficult to imitate. And since P&G is organized to capitalize on them, this creates a sustainable competitive advantage. Their strong retail relationships and shelf access, as well as supply chain management and financial resources, are valuable but not rare or inimitable. Their strong retail relationships and shelf access, as well as supply chain management and financial resources, are valuable but not rare or inimitable. These contribute to competitive parity. P&G also shines in sustainability initiatives and ESG leadership, which are both valuable and rare. However, since they can be copied, the edge is temporary. Lastly, their experienced leadership and strategic vision are valuable and rare but not inimitable, again leading to a temporary competitive advantage. On the other hand, let us delve into the value chain analysis for Unilever. In primary activities, inbound logistics, Unilever uses both traditional distribution and a growing direct dispatch model. While many products still move from factory to distribution centers, 16% now skip that step, going straight to retailers. This shift cuts emissions, lowers costs, and speeds up delivery with a 25% rollout target by 2026. Operations: Unilever operates through around 500 companies in 75 countries. Major product groups lead in Europe and North America, while regional teams manage elsewhere. Their localized manufacturing cuts transport costs and responds faster to market demand. Plants are designed for flexibility, using automation and robotics to boost productivity. Quality is ensured through defect threshold set using market data and trends, keeping products aligned with evolving consumer expectations. Outbound logistics. Unilever products reach 2.5 billion daily across 190 countries. With over 400 logistics warehouses worldwide, they deliver 150 billion products to millions of retailers via wholesalers, stores, and online platforms, proving their vision to serve people everywhere through every channel. Marketing and sales. Unilever's marketing is rooted in purpose, inclusivity, and transparency. Guided by the principles Get Real, Do Good, and Be Unmissable, they craft campaigns grounded in real consumer insights. Initiatives like Dove's Real Beauty and Persil's Dirt is Good built both social impact and brand loyalty. Their efforts are paying off. Brand and marketing investment rose of 120 BPS to 15.5% to its highest level in over a decade. Moreover, they have achieved an underlying sales growth of 4.2%, led by 2.9% volume growth. Service. The company actively seeks feedback from consumers, stakeholders, and partners to refine its approach. By staying responsive to emerging trends and evolving consumer expectations, Unilever ensures that its purpose remains relevant and impactful. Unilever enhances after-sales service through AI-driven customer care, resolving concerns faster, offering real-time support, and tailoring experiences based on feedback. This consumer-centric approach strengthens trust and loyalty while ensuring satisfaction long after purchase. Support activities also play a key role, starting with firm infrastructure. Headquartered in London, Unilever runs on a global system of production, supply, and retail, serving top brands like Dove, Knorr, Magnum, and more across 5 major segments. Following this is human resource management. Unilever employs 125,000 people globally, putting great importance on diversity and respect and inclusion through programs like Allyship, which promotes equity, and Curiosity, a learning module deepening understanding of LGBTQI+ communities while also supporting all life stages with inclusive leave policies. For technology development, Unilever's efforts to shift to 100% cloud-based systems fueled innovation and sustainability, deploying over 500 AI capabilities to optimize supply chains, product development, and manufacturing. Their Toronto-based AI hub and responsible AI framework governs how they develop, deploy, and use AI, which is vital in shaping the company's AI strategy, helping them to focus risk and strategically focus the way that they use it. Lastly, procurement. Unilever's procurement goes beyond sourcing. It's about impact. In Thailand, their Jasmine Rice project empowers farmers with regenerative practices like soil testing, cover cropping, and organic inputs. This boosts soil health, cuts CO2, and increases farmer incomes. It's part of Unilever's wider push to support 250,000 smallholder farmers and reduce Scope 3 emissions by 2030. Unilever's Growth Action Plan 2030 focuses on delivering consistent, higher performance through 3 key pillars: focus, excel, and accelerate. Focus prioritizes Unilever's top 30 power brands and 24 lead markets, driving 75% of turnover. By concentrating investments in innovations like the direct dispatch model for brands such as Dove and Knorr, and ethical sourcing initiatives like the Living Wage Promise, Unilever strengthens its core portfolio. Excel ensures unmissable brand superiority, optimizing every touchpoint, product, packaging, and pricing, using AI-driven tools for precision in customer engagement and demand forecasting. Sustainability initiatives like biodegradable packaging reinforce Unilever's commitment to environmental leadership. Purpose-driven marketing campaigns like Dove's campaign for Real Beauty foster trust and reinforce brand values. Accelerate drives internal information with cloud-based systems, AI and automation, enhancing productivity and decision-making. Unilever's commitment to sustainability and diversity and inclusion ensures a resilient, inclusive, and adaptable organization. Alright, let's take a deeper dive into Unilever's internal strength using VRIO framework. This analysis helps us understand which of their resources and capabilities truly provide a competitive advantage. First, we look at assets giving Unilever a temporary competitive advantage. Their strong global brand portfolio, think of names like Dove, Knorr, Rexona, Axe, and Surf, is clearly valuable and difficult for competitors to instant replicate due to decades of building trust and recognition. While not entirely inimitable, over the very long term, it is definitely rare and organized to capture value, giving them an edge. Similarly, Unilever's innovation and R&D capabilities are valuable and relatively rare. Their ability to develop new products and adapt consumer trends helps them stay competitive. Their experienced leadership and strategic vision is also a valuable resource. Skilled leadership is rare and crucial for guiding a large organization, though leadership teams can change or strategies can eventually be adapted by rivals, making them the advantage temporary. Now, let's consider the resources that lead to competitive parity. These are valuable and necessary for playing in the market but not truly unique. Unilever possesses a global manufacturing and distribution network, which is vital for reaching customers worldwide. But comparable networks exist among their large competitors. Their strong retail relationships and shelf space access is incredibly important for sales, but is a capability that most established consumer goods giants also maintain. Additionally, their sustainability initiatives and ESG leadership, while valuable and increasingly important to consumers, are becoming industry standards rather than rare differentiators. The same applies to their well-developed supply chain management and substantial financial resources and capital access. These are critical foundational strengths, but largely matchable by other major players in the consumer goods space. We move forward to the financial analysis of the rivals and relative to Kimberly-Clark. Looking at revenue trends, P&G showed consistent growth while Unilever saw more volatile growth. Relative to that, Kimberly-Clark experienced lower growth and a decline in 2024. You can see their varying compound annual growth rates highlighted on the slide. As for the vertical analysis, income statements highlight COGS as primary cost, with P&G leading operational margin. Balance sheets show that financing differs, that KC uses the most liabilities, followed by Unilever, while P&G uses the most equity. Cash flow composition shows P&G with the highest operational cash generation relative to sales. Looking at liquidity, current, and quick ratios, we're below 1 for all companies. P&G saw a decline but recovered in recent years. Unilever's liquidity remains similar. KC has the lowest initial cash ratio but saw a significant increase, even surpassing rivals recently. Turning to solvency, P&G has the lowest financial leverage and strongest interest coverage. Unilever has moderate leverage and sufficient but lower interest coverage. KC shows the highest leverage despite recent reduction and general lower interest coverage. Turning now to profitability, here are the graphs. P&G consistently leads in profit margins, followed by Unilever. Kimberly-Clark generally has the lowest margins, Unilever shows the lowest return on assets, and KC exhibits extraordinarily high ROE, strongly driven by its financial leverage. Looking at the activity ratios again, presented are the graphs. P&G is most efficient at collecting receivables. Unilever takes the longest to pay its suppliers, while KC leads in inventory and asset turnover, and pays suppliers the fastest, but lags in receivable collection. Analyzing cash flow ratios, P&G leads in converting revenue to operational cash. Unilever shows strong cash relative to income, but has the lowest debt coverage. Kimberly-Clark lags in cash flow to revenue, but has better debt coverage than Unilever despite its leverage. Finally, our DuPont analysis breaks down ROE into profitability, asset efficiency, and financial leverage. P&G's ROE is primarily driven by its strong net profit margins. It has lower asset turnover and the least leverage among the three. Unilever shows moderate margins and turnover with higher leverage than P&G, significantly influencing its ROE. KC exhibits remarkably high ROE despite generally lower margins due to high asset turnover and exceptionally high financial leverage. The industry's 8 key factors identified in external analysis is sustainable innovation, cost efficiency, AI and technology investment, digital transformation, emerging market expansion, financial discipline, brand trust, and ESG leadership. To stay ahead, companies must innovate with biodegradable materials and ethical sourcing. Boosting supply chain resilience through automation and local production is vital in today's volatile market. AI-driven systems can streamline operations and deepen customer insight. With e-commerce rising, a strong digital and direct consumer presence is essential. Tapping into high-growth regions like India and Nigeria requires tailored, affordable products. Financial health must improve by reducing debt and increasing operation margins. Lastly, brand loyalty and ESG leadership are critical in today's purpose-driven economy. Failing to act on these priorities risk market share loss, weaker margins, and long-term brand erosion. Lastly, a quick three-way comparison for P&G, Unilever, and Kimberly-Clark. Starting with strengths, Procter Gamble leads with powerful brand portfolio like Tide, Pampers, backed by heavy R&D investment and cutting-edge AI tools. Unilever excels in purpose-driven branding and global reach, with over 500 AI capabilities and sustainability leadership. KC stands strong with trusted hygiene brands like Huggies and Kleenex, efficient operations, and strong supply chain control. Weaknesses. P&G scale can create internal complexity and cost pressures. Unilever's higher leverage and inconsistent marketing impact some performance. KC lags in innovation and digital adoption with slower growth and lower margins than peers. Opportunities. All three can depend in emerging markets and invest further in sustainability. P&G can leverage AI for personal marketing. Unilever can scale its direct logistics and model globally. Kimberly-Clark has room to grow in digital transformation and sustainable packaging. Threats. They all face rising raw materials costs, They all face rising material costs, environmental regulations, and intense competition, especially in hygiene and personal care categories. So, still think you've got what it takes to make it in the hygiene hustle? If you're ready to face the forces, armed with pulp, power, and price wars, then welcome to the FMCG battlefield. Now go, and may the tissues be ever in your favor.